When it comes to taxes, the average person files their return, pays what's owed, and moves on. But for the ultra-wealthy, taxes are just another game to be played, with rules to bend and loopholes to exploit. The truth is, most rich people don't evade taxes in the illegal sense. They simply avoid them using the full power of the law. Armies of accountants and a tax code built to favor those who own more than they earn. It all starts with understanding that income is taxed, but wealth is not. That fundamental truth is the bedrock of the rich's entire strategy. While the average worker earns a salary and gets taxed on every dollar, the wealthy rarely take home a paycheck in the traditional sense. Instead, they invest in asset stocks, real estate, businesses that grow in value, but don't trigger taxes until they're sold, and sometimes not even then. This is the magic of capital gains, and even more powerful, unrealized capital gains. When an asset like stock goes up in value, the owner isn't taxed until they sell it, and if they never sell, they never pay. This is why billionaires can live incredibly lavish lifestyles. While officially earning very little income, they borrow against their assets instead of selling them, using low-interest loans backed by their growing portfolios. This strategy to borrow don't sell is completely legal and incredibly effective. It is how someone worth hundreds of millions can technically report a taxable income of just a few $1,000s. Then there's the infamous step up in basis. When someone dies, their heirs inherit assets at the current market value, wiping out decades of unrealized capital gains. That means no taxes ever have to be paid on that appreciation. It's generational wealth transfer on steroids. And it's one of the most powerful legal tools in existence for keeping money in the family, but that's just scratching the surface. Real estate is another gold mine for tax avoidance. Through depreciation, wealthy landlords can deduct a portion of the property as value each year, as if it is losing worth, even though it's often appreciating. That phantom expense can cancel out rental income and reduce tax bills to zero or even create a loss on paper. When combined with 1031 exchanges, where investors roll profits from one property into another without paying taxes, it becomes a game of deferral, year after year, decade after decade. And if they die before cashing out, again, the step up in basis erases the entire tax liability. The tax code is also packed with incentives designed to encourage behavior the government wants to promote, like investing in small businesses, renewable energy, or opportunity zones. For the wealthy, these incentives are treasure maps. Credits, deductions, and deferrals aren't loopholes to them, their strategy. For instance, investing in certain low-income areas can generate tax credits, while the underlying asset still appreciates. It's not charity, it's profit, wrapped in a tax incentive. And then there's philanthropy. Donating to charity can slash tax bills dramatically, especially when assets like appreciated stock are given instead of cash. The donor gets to deduct the full value, avoid capital gains tax, and still retain influence if they donate through a foundation they control. That's the kicker. Many of these charitable foundations are run by the same families that fund them, giving them continued power over how the money is used, often for generations. It's a way to direct wealth with favorable optics and tax benefits. And let's not forget retirement account. While the average person might contribute a few $1,000s a year to an IRA or foreign, the ultra-rich use backdoor Roth IRAs, mega backdoor strategies, and defined benefit plans that can shield millions from taxes. They structure their compensation and contributions in ways that allow them to defer taxes for decades while investments grow tax-free. Business ownership is another powerful shield. By owning companies, the rich can write off a wide range of expenses: travel, meals, home offices, vehicles, even their children's education if structured properly. The line between personal and business becomes incredibly blurred, especially when the IRS allows so much discretion. And if the business is structured as an S-corp or LLC, income can be distributed in ways that reduce exposure to payroll taxes or qualify for special deductions like the 20% pass-through. Trusts also play a critical role. Sophisticated estate planning tools like grantor-retained annuity trusts, intentionally defective grantor trusts, and spousal lifetime access trusts allow wealth to be passed on with minimal or no estate taxes. These are not shady schemes, they're well-known, well-used legal strategies embraced by the financial elite. Internationally, things get even more complex. The wealthy use offshore accounts, shell companies, and residency tricks to take advantage of global tax arbitrage. By living in one place, earning in another, and banking in a third. They can minimize tax exposure to the point where their effective tax rate is in the single digits. Not illegal, just smart. Take Puerto Rico, for example. Under Act 60, certain individuals can move to the island and pay virtually no capital gains taxes. That's why crypto traders, hedge fund managers, and entrepreneurs have relocated there in droves. The system rewards those who know how to play the game. Even stock-based compensation is a tax strategy. Instead of being paid in cash, executives are paid in options or restricted stock units, which are taxed only when exercised or sold. And if they hold the stock long enough, they qualify for lower long-term capital gains rates. Again, the focus is always on deferral and minimizing taxable events. The IRS, underfunded and overwhelmed, lacks the resources to effectively audit the wealthy. While audit rates for low-income filers claiming the earned income tax credit have historically been higher, the rich are rarely scrutinized despite the complexity of their returns. The sheer number of gray areas and the army of lawyers standing by make audits costly and difficult to win. So the system remains tilted. Political influence plays a role too. Many of the tax breaks that favor the wealthy exist because of lobbying, campaign donations, and revolving doors between government and the private sector. Laws don't just happen, they're shaped. The result is a tax system that, while technically fair on paper, is deeply unequal in practice. The more money you have, the more ways you can protect it. Meanwhile, the average person sees taxes as an obligation, not an opportunity. They don't have the time, knowledge, or access to take advantage of the same strategies. The tax code is thousands of pages long, and buried within are countless clauses written for very specific interests. It's a puzzle designed not to be solved by ordinary citizens, but by those who can afford help. And even when loopholes are closed, new ones are opened. It's a moving target, but the rich always stay ahead. Some even relocate their citizenship entirely. Renouncing US citizenship and becoming a citizen of a lower tax nation is extreme, but it's happening more than ever. The wealthy understand that where you live and where you're taxed are not necessarily the same. In a world of mobility, borders are just lines to be negotiated. Private equity is another playground of tax minimization. Carried interest, the portion of profits earned by fund managers, is taxed at capital gains rates instead of as regular income. Despite calls for reform, this loophole remains in place, saving billions for a tiny segment of society. And then there's insurance. Wealthy individuals use permanent life insurance, not for death benefits, but as a tax-deferred investment vehicle. These policies grow cash value tax-free and can be borrowed against, just like other appreciating assets. It's yet another way to access wealth without triggering taxes. In short, the rich don't just avoid taxes by accident. They hire the best minds, exploit the most obscure rules, and build lives around the concept of deferral, deduction, and control. They don't break the law, they shape it. And while politicians may talk about closing loopholes, any real reform is slow, watered down, or blocked entirely by the same interests that benefit from the status quo. The result is a system where the richer you are, the less you pay. It's not about cheating, it's about mastering the game. The tax code is not a moral document, it's a strategy manual. And the rich are simply better at reading it. Whether it's through family offices that manage billions, offshore entities that protect assets, or complex legal structures that transfer wealth across generations, the tools of tax avoidance are vast and powerful. Most people will never access them, but that doesn't mean they don't exist. They exist in plain sight, just not in plain reach. And that is the quiet brilliance of how the rich avoid paying taxes.